day, everyone. Thanks for joining us here for another episode of IRA Conversations with Appleby. I have here my very good friend, John Neyland. John, how are you?
Denise, it's wonderful to be with you today. I'm doing fantastic.
It's great to be with you too. Now, before we begin, John, I want the audience to know a little bit about you and your business. So give me your elevator summary of what you do for your clients and what your business is about and who you are.
Well, I'm a fiduciary, which means that I don't earn commission. And our primary tool we is the plans. We're financial planners. And once we do a plan, we determine what type of investments they should have, what type of retirement accounts they should have. And we monitor that on a year-by-year basis.
And what's the name of your business?
JCN Financial and Tax Advisory Group.
Fantastic. And today we're here to talk about Roth conversions. Funding Roth IRA in general, which is a very hot topic. It has been in the news recently. I think the Republica wrote an article about Peter Thiel and how his Roth IRA grew from 2,000 to 5 billion.
Yeah, I'll trade.
Yeah, I know Congress is planning to go after Roth IRAs, but in the meantime, until they make up their minds, we can still help clients to fund Roth accounts. So part of what we want to talk about here today is the Roth conversion. And one of the questions that I usually get is, what type of accounts can be converted to Roth IRAs? Do you get that question too?
Yeah, I sure do.
And part of what you and I talked about before was you can do traditional, SEP, simples, and even accounts on the employer-sponsored retirement plans to Roth IRAs, as long as the amount is rollover eligible. Part of what you told me earlier was you find out the age of your clients, because if they're at least age 72, you tell them you got to take your required minimum distribution before you do any conversion, because that's the law. Tell me some of the other things that you do with your clients before you recommend a conversion.
Well, if you're going to build a house, you're going to build a $500,000 house. And I come to you and say, Denise, I'll build your house. I'll put 5 bedrooms in it, 3 bathrooms, tell you all you want to have. But you say, well, John, can I have a set of the blueprints? And I said, no, I don't use blueprints. I just use my head. What would you say?
I'd say, I don't know about that. Tell me more.
So I think if you look any financial planning, and in particular Roth conversions, you must have a financial plan. Nobody is good enough or smart enough to do it just off the hip. So you want to do a financial plan. Now I will tell you the most common single misnomer I run across. And I run across this most often from engineers. They'll say, John, I want to convert to a certain bracket. And I'll say, okay, what bracket is that? It may be 28%. I said, why is that? I don't want to pay any more tax than that. Now, so let me ask you a question. You convert into a higher bracket, meant you pay lower taxes overall. Would you want to do that? So Denise, I've done over 1,700 Roth conversion plans, a bunch of them. You would think that's enough where I could look at an account and know what to do. And I'm not that good yet. So you don't want to just take an opinion. You do not want to take that rule of thumb to the bracket, because most often when I do these analysis, I find that you're better served to convert to a higher bracket. Because what happens is this, Denise, let's say you've got $1 million IRA, and whatever you don't convert, it grows. It grows tax deferred and taxable. So if you make 10% on that account the next year, you've converted 100,000, you have 900 left in there, your tax bill goes up by $90,000. So long and short, you cannot do this properly without a plan.
Yeah. So what I hear you saying, John, a client walks into your office and they tell you, the Wall Street Journal says the Roth is the best thing since sliced bread, and everybody else agreed. I want to do a conversion. And based on what you're saying, you say to the client, well, that sounds like a great idea, but let me see whether or not it works for you. And in order to make that determination, I am going to do a Roth versus traditional analysis and see how your Roth profile stands up to the analysis. Then you make a recommendation. Is it good for you? And if it is, do you convert the entire amount, or do you do what is referred to as micro conversions where you convert a little bit every year, because there's nothing that says you have to convert the whole account at the same time.
No.
You could do any percentage or any dollar amount, right?
Yeah, you could. And so the one number we look at a lot of these plans are what's called the excess cash flow due to RMD. As a rule, you want to convert at least enough to eliminate that. So what is that? Well, let's say you need $80,000 a year to live on, and you have $30,000 in Social Security. So that's $50,000 more you need. But if your RMD is $100,000, you got $50,000 more than you want or need that must come out of the IRA, is taxed. And then, as you know, it's too late then to put that into a tax-free Roth. So I really look, this has been a real tool for me, is excess cash flow. You know who does this? The software is Ensmark. And we've been using that for like 16 years. It's just essential.
Yeah. And, you know, I think it's such a great thing that you do that, because I agree with you. When it comes to retirement planning, financial tax, there is no one size fits all. You have to do an analysis to determine what's suitable for the client. But part of what I like about what you do, because we have had many conversations about this. And, you know, just last week you were saying to me, Denise, Roth conversions are great, but people do make regular Roth IRA contributions as well. And you talked to me about a Roth income creep, where you have clients who were eligible to make Roth contributions years ago, but they're not anymore. And advisors are not asking that question. So you were eligible years ago. Let's see if you're eligible now, because you got a promotion, you got a salary increase. Let's check to see if your income exceeds the modified adjusted gross income limit. Because if it does, you can no longer make regular contributions to your Roth account, but you could make a backdoor Roth contribution. That's what and I really like the fact that you do that, John, because I see a lot of cases where people are making contributions to their Roth IRAs when they're not eligible to do so. And that creates a lot of complications, excess contributions, where if it's not corrected timely, it's subject to a 6% excise tax for every year it stays in the account. So I really like the fact that you dig into your client's Roth profile, so to speak, to make sure that they're eligible for Roth contributions as well.
Well, the reason I think it's so important, if you think about what I do as an advisor, after I do all of these things, eventually I've got to invest your money in the stock market. When I do that, I don't have guarantees of anything there. But when you're looking at a conversion, okay, it's going to be for your client. Your analysis is going to provide, at the very least, an opportunity, or the very most, avoiding a mistake. The reason you have to know is to avoid that mistake. So the job you have, your position, what I like about it so much is you know the rules, how they work. That's very important. And then I learn from you and others how to implement those rules. And really and truly, in this financial world, if everybody you meet could look at the mistakes they made and avoid those, people who don't have enough money today would, and people who do have enough money would have more. And I find very seldom when people come to my office, do they have a plan for anything, for the Roth conversion, for their future. And so the Roth, as we talk about the conversions or either contributions, either one, that's either an opportunity, a missed opportunity, or a mistake. And we should have no mistakes, because the thing is, we know what the mistakes are and how to avoid them. We don't avoid them because we're not diligent.
Yeah. And you know, sort of putting the cart before the horse here. You know, for people, by now, most people know why Roth IRAs or Roth accounts is the greatest thing since sliced bread. But just in case someone doesn't know, why many people like the Roth IRAs and Roth 401ks, designated Roth accounts, is because, yes, it's funded with amounts that have already been taxed, but eventually earnings becomes tax-free once the owner or beneficiary is eligible for what is referred to as a qualified distribution. So someone who's retired, taking distributions from their Roth accounts, and I've had a Roth IRA for at least 5 years, and say is at least age 59 and a half, all of those distributions are going to be tax-free and not subject to the 10% early distribution penalty. It's a beautiful thing. So I know people who are watching right now are saying, well, how do I get in on that? It's so fantastic.
Well, let me share with you a story that I find quite humorous. A client of mine years ago, probably 17 years ago, it was an engineer. He wanted to do Roth conversions. And I developed a plan that over a 3-year or 4-year period, we converted all of his money to Roth. And he looked at it, he did his math. We were both real happy, Denise. So he comes to do the first conversion, and he's just complaining about the tax due, and he's blaming me. So I said, listen, you don't have to do this Roth. So he does it. The next year he comes in, he's complaining again, right? I'm starting to feel guilty. I mean, I know it's a good thing, but I'm thinking, maybe you shouldn't do it. We finally get all his money converted. And at my office, we have a big room. We have classes and we have refreshments afterwards. And I heard this gentleman talking and heard him bragging to his coworker that worked at the same place. And this is the absolute truth, Denise. He was bragging about all of his IRA money is now Roth tax-free money and how much better it makes his retirement. I went and grabbed him. I said, did you tell him I told you to do that? So that's the thing. You have to pay the tax on it, but it's kind of like when you pay the tax for the Roth, that's like planting the seed.
Yeah.
But when you harvest the crop, that's the Roth. And so the other thing you must know is how to invest that Roth. So and when to use that Roth. So if you have a variety of assets invested, stocks, bonds, Roth, non-IRA, which one do you touch first and which order? As a general rule, since Roth is tax-free, you want that in your highest earning account, right? So I want the thing's going to make the most to give you the most. And I learned this from CPA Ed Slot years ago. I've learned a lot from you, and I've done a tremendous amount of them. And it's really a way a consumer that's worked their whole life scrimping and saving can finally take control.
Yeah. And another good thing about the Roth account too is there's no required minimum distributions for account owners. Whereas for, I should say Roth IRAs specifically, because if we're talking about accounts like Roth 401ks, those are subject to required minimum distributions. And what we find is that some individuals do not want to take those forced distributions that must begin when the owner reaches age 72. So with a Roth IRA, they get that wish. They can choose whether or not to take distributions, but they don't have to. But if they keep it in any other type of account other than a Roth IRA, then they're going to have to take required minimum distributions. Beneficiaries are a different matter. If you inherit a Roth IRA, you have to take required minimum distributions unless you are the surviving spouse of the account owner, and then you choose to move it to your own Roth IRA, then you're subject to the owner rules and no required minimum distribution applies. So you have all those funds growing on a tax-deferred basis where it eventually becomes tax-free. It really is a beautiful thing.
You know what, Denise?
Mm-hmm.
That's a lot of rules, isn't it?
It's a lot of rules, and we haven't even talked about all of them.
and quite frankly, that's one of the reasons my firm retains you.
Yes.
Is as much as I know, I don't know as much as you do. And I shudder to think about the person out there doing this on their own. It's quite remarkable. It's kind of like, so why are you doing this Roth conversion, or why are you investing your money on your own? And they say to save money. And then I say, well, do you do your own dentistry as well? So, what do you mean? I said, when you need to fill a tooth, do it yourself. No, I don't do that. I said, why don't you save some money?
Yeah, it's a specialized area. We talked about, for instance, the fact that if you are in your R&D year, you have to take your required minimum distribution before you convert the amount. That's only one of the rules that you need to think about. If you're converting from a simple IRA, for instance, to a Roth IRA, you have to have had that simple IRA for at least 2 years, or it has to have been funded with a simple contribution for at least 2 years. If you're doing a Roth conversion and you ask to have income taxes withheld, then here's something to think about. Let's assume that you're converting $100,000 and you say to your IRA custodian, withhold 20% for federal income tax. Only 80,000 hits the Roth account, so your conversion is only 80,000. And the 20,000 that was withheld, that's really a regular distribution subject to the 10% early distribution penalty if you're under age 59.5, whereas the 80,000 that gets converted to the Roth is not subject to the penalty. So you just got to be careful with these rules and make sure that, as you said, it's not something that you do on your own.
No,
a professional who is an expertise in this area, not just any financial advisor, but a financial advisor like you, John, who you know these rules, and then you recognize that because you have so many areas that you had to cover, you ensure people are on your team who knows the nitty-gritty stuff that you have to apply when you're helping your clients.
Yeah, well, I call you for the nitty-gritty. I'll tell you a common misconception, I think, is just to show how uninformed people are. They say, well, you know, if I put my money into a Roth, I convert to a Roth, I can't take it out for 5 years. Well, yeah. You can't take your earnings out tax-free for 5 years, but you can take your contribution out the next day if you want, penalty and tax-free.
That's exactly true. And what you're talking about is the R&D rules, because I know from the checklist that you use to work with your clients, when a client says to you, John, I want to take a distribution from a Roth IRA, the first thing you do is find out if they're eligible for a qualified distribution, in which case it would be tax-free and penalty-free. And if they're not, then you apply the ordering rules, which says your regular contributions come out first. Those can be taken anytime.
Stop a second. That's the thing, Denise, to a person, people don't know that rule. It's in the last 5 years, I've had one person understand that rule. Incredible to me. You know, it's a kind of an obvious, you think people would hear that once and say, gee, I want to be aware of that.
Yeah. And the lesson here is, I'm speaking to your clients specifically. If you have someone like John on your team, don't try to do it on your own. That's why he's there. Talk to him about Roth accounts and your other retirement accounts, because what we're talking about here today is not even a 0.001% of the things that an advisor needs to know to help clients with their retirement accounts.
Well, we do, as you know, we do a lot of client education, and you just worked with me on the Roth conversion presentation we're going to be doing here shortly. And that presentation is going to bring a lot of top level things to the top of mind. But when you get into the world of finance or taxes, it's very important to have an expert do that, whatever it be, because it's these mistakes, all these mistakes can be avoided. And the only reason they're not avoided is that people don't know any better.
Yeah, and these mistakes are so costly. You know, one mistake can erode years of tax deferred saving, all the planning that you have done. And again, not something that you want to do it on your own. I'm really enjoying this conversation, John. Is there any final words that you have before we wrap up?
I had a client recently. If it's too good to be true, the IRS sees that, you're not going to be able to do that. So the biggest, for people that are watching these videos, the biggest single thing you can do, and I learned from Ed Slott as well as you, Roth contributions, conversions, and you can also use life insurance for income planning, getting money out tax-free, which can be very, very beneficial, because once you do that, you don't have the preclusions that a Roth might have. So 7702. Special way of using life insurance is not about just going to buy a policy, but you buy it to where you get the least amount of coverage possible, so that your money that you're adding to the policy comes back to you income tax free. So between the Roth IRA and 7702, you can buy some tax credits, which will give you some minimal kind of help. But that's really the first two things. And you do that.
See, so complicated. And, you know, that's one of the reasons why we need to work with a professional, because you read a lot of stuff on the internet and you read IRS publications, etc., and you may think that you know it all. But here you come, for instance, talking about 7702, which is something that a lot of people don't think about and something that could be helpful to your clients.
My son is 31, Denise. We had lunch today. He's a helicopter pilot. He brought that up to me. He goes, Dad, he goes, remember years ago, we were showing me how I could use life insurance to have a tax-free income? Because I was trying to show it to my coworker, but I didn't remember this or that. And the greatest takeaway I had from that was he listened to me 3 years ago.
Congratulations.
That's amazing, huh? That tax planning thing, Dad, you told me 3 years ago over lunch, I remembered. So just before, it's just a whole lot harder to understand it. It's kind of like the difference between the guy that actually plays football and the guy that tells you how to play football. It's doing something versus intellectually having a plan for it.
Exactly. Well, thank you, John. This has been fantastic. I enjoyed it. I know I learned something from it, and I'm sure the audience will as well. Thank you very much.
Well, I always enjoy talking to you, Denise, anytime.
Same here.
Thank you.
Thank you guys for listening to us. This has been another episode of IRA Conversations with Appleby. And in the comment section, I'll include the information about John, where to reach him, link to his website and his social media handle. Thanks again, John.
Thank you.
Really enjoyed this conversation.
All right.
Thank you.